Ladies and gentlemen, whenever we talk of adjusted present value borrows heavily from where? Heavily from MM2. And that is why if today somebody was to ask you anything to do with the assumptions of APV, ladies and gentlemen, most of them will be quite similar to what here the MM2 assumptions: availability of taxes, debt equity, mode of financing, etc. So when we talk of MM2, remember MM2, they gave us a very important model for getting value of a levered organization. And for us to get value of a levered organization for MM2, is there anybody who can recall the formula? Is there anybody who can recall the formula of MM2? Value of a levered firm equals who? I have value of unlevered. So it's value of unlevered plus what here, somebody? Plus DT. Thank you very much. Value of a levered firm equals value of unlevered firm plus debt times what here, somebody? Tax, like that. Now, ladies and gentlemen, remember, according to MM2, basically this gives us the value of a firm as a result of what we call business risk. As a result of what we call the business risk. And then, of course, this other component here now looks at the risk to the firm. Firm valuation as a result of what here, somebody? As a result of financial risk. That is what here? Risk associated with what here? Borrowing. Risk associated with borrowing. And that is why the APV, adjusted present value, will always, ladies and gentlemen, be equal to, ladies and gentlemen, anytime we talk of adjusted present value, we'll always take the base NPV, the base case. It's base case net present value plus, ladies and gentlemen, present value of what here? Financing effects. Present value of financing what here? Effects. Present value of financing effects. Please andika namna hii. APV stands for what here? Adjusted present value. Adjusted present value is base case net present value. Base case net present value plus present value of financing effects. Present value of financing effects. Now, ladies and gentlemen, I would want somebody to talk to me tonight. When we talk of base NPV, the base case NPV, what do we mean? We are looking at the value. We are looking at the net present value of unlevered firm. Net present value of unlevered organization. The net present value of unlevered organization. The net present value of unlevered. A firm that does not have what here, somebody? Debt inside of it. A firm that does not have debt inside of it. So it will be NPV over unlevered firm. When we talk of NPV of unlevered firm, what do we mean? Ladies and gentlemen, when we talk of NPV of unlevered firm, it basically means that we discount the cash flows. We discount the cash flows using KU. 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 KU stands for what in full, somebody? You know, if an examiner wants to be very rough with you as regards advanced financial management, he will bring these kind of questions here if he wants to be very rough on you. And that is why for the remaining lessons, which should be about 10 lessons actually, 10 lessons, remaining lessons should be about 10 or more. We'll be looking at the worst case scenario. The worst case scenario. What if in this case here we get just our examiner being crazy on us, right? And it gives us questions that my students here at times read, and then they ask me, Mwalimu, was that really advanced financial management or home science? So I can see all of them, they are telling me that KU stands for what here, somebody? Cost of equity of unlevered organization. Cost of equity of unlevered firm. Thank you very much, and I hope everybody has been able to write this cost of equity of unlevered firm nicely, in full. But now there are two formulas of getting KU. There are two formulas of getting KU. Perhaps nobody in this class has ever heard of that. Because as you may not be knowing, advanced FM is quite wide. Even if I'm given like 6 extra months with you, trust you me, I'll have new content to be teaching under this paper every other day for the next 6 months. Right? So basically what we do is to cover, yes. Thank you very much. Like now I've seen Peter Motier coming up with a very good argument. The first one, I don't know who told Peter Motier about this. Perhaps he did research. Perhaps he went to YouTube. I don't know. That for us to be able to get this cost of equity, we can come and get cost of equity using CAPM. We know one of the functions of CAPM, and this was asked just the other semester when they asked us to give them a list of the uses of CAPM. Ladies and gentlemen, CAPM is used to calculate cost of equity. So our CAPM, cost of equity, will always be obtained by us taking risk-free plus ERM minus risk-free multiplied by beta what here, somebody? Multiplied by beta equity, 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 multiplied by beta what here? Beta equity, multiplied by beta equity. But now you and I, ladies and gentlemen, remember you and I, ladies and gentlemen, do appreciate one fact, that this there is beta equity. This is beta equity, and the beta equity is always equity of levered organizations. Is beta equity of levered organizations. Beta equity of levered organizations. Beta equity. It's equity of levered organizations. But we have said, but for base case, NPV, we should use KU. We should use KU. But for base case NPV, ladies and gentlemen, we should use what we call KU. KU, you're the ones who have told me it is cost of equity of an unlevered firm. So then, ladies and gentlemen, what I would need to do at the end of the day is to work with unlevered beta. Therefore, our CAPM KU now will be equal to RF plus ERM minus RF, but now multiplied by BER, where BER stands for beta assets, where BER stands for beta what here? Beta assets. BER stands for beta assets. BER stands for beta assets. Beta assets or unlevered beta, beta assets or unlevered beta or unlevered beta. Now, can somebody talk to me tonight? How should I get to play around between these two types of betas? Which model do we make use of to change one beta here to the other? One beta to the other. Which model do we use? There is a special model that is used whenever you want to move. Very good. You can see what Liz is telling me. You can see my friend Mary. You can see Rose. Phoebe. All of them are saying what here? Hamada's model. Hamada's model. Now let's go back to our question. So in our question, ladies and gentlemen, what they want us to do, Hamada's model has to be used. You see, Hamada's model is like a must come in your exam because it's like it features in so many areas, valuation, etc. Features like in all those areas there. So Hamada's model is a key model, So what have they told us here? They've told us something very nice. Ladies and gentlemen, what they have told us in this question, what they have told us is that I'm reading paragraph number 2, line number 2. Debt issue costs are allowable for taxation, right? The plastic industry has an average equity beta of 1.368 and an average debt to equity ratio, of 1.5 at market values. Blade Limited's current equity beta is 1.8, and 20% of its long-term debt is represented by debt, which is generally regarded to be risk-free. I like that. This is a serious examiner. He has gone ahead. Of course, what he has done, he has given me equity beta. Perhaps I need to underscore this. And there is a lady crying somewhere there that she doesn't have a question. There's a lady crying somewhere there that she doesn't have a question. It's wrong of us seeing our ladies crying. Yeah. If it was Peter Mutie, I would have assumed, right? Like Abdi now, I can assume he's saying he doesn't have the question that I can. No, I'm just joking. They have already sent it on WhatsApp. They have sent the question on WhatsApp. Do we have now the question, all of us? Do we have the question, all of us? Just a minute. Every time you want to use a Hamada's model and the examiner has given you two beta equities, one for the farm, specific beta equity for the farm, and another one, ladies and gentlemen, for what here somebody, for the industry. We always go for gearing, or rather ungearing beta equity of the industry, which in this case here is 1.368 like that. So remember how Hamada's model works like. Hamada's model is quite an interesting one, and that is why most of us have forgotten the formula. Nobody is able to give me that formula. Yeah, Hamada. And this is the last time I'm doing these Hamada's things. I've really talked about this Hamada's model for so long. It should be the last time. So is there anybody who is able to remind us the Hamada's equation? They are not talking. No. That's not Hamada's model. Yes. So the gentlemen, under Hamada's model, we are saying that our beta, our beta equity equals our beta equity equals, our beta equity, I can see in this case here, people coming up with several models. Beta equity equals beta assets into 1 plus debt over equity into 1 minus what here? 1 minus tax, like that. This is the proper Hamada's model. This is the proper Hamada's model. So please don't confuse here that whatever we have here, 1.368 is beta equity. 1.368 is beta equity. We are looking for beta assets of the industry, the ungeared beta, which will be 1 plus. Is there anybody who is able to see the debt to equity ratio for the industry? Debt to equity ratio for the industry. Debt to equity ratio for the industry. Is there anybody who is able to see that figure? For the industry, they're saying 1/5. They're saying 1/5. So the average debt to equity ratio, I think how that question was written in the revision kit, they must have taken quite a bad figure there. It should be 1:5. What they're giving us there is a debt to equity ratio. Debt to equity ratio is 1:5. Is 1:5. 1:5, yes. Debt to equity ratio is 1:5. So I would want to see, ladies and gentlemen, how will you apply this 1:5 in your formula? How do you apply the 1:5 to your formula? Could you kindly try to plug in this thing and then you give me beta assets? Try to plug in this thing to give me the beta assets. So it is 1:5. 1:5, it means that debt is what here, somebody? 1. Equity is what here, somebody? Is 5. Is 5. Is 5. So in the interest, ladies and gentlemen, of time, this means that debt over equity is 1/5. So here it will be 1/5 times. Have they given me the tax rate? Have they given me the tax rate, ladies and gentlemen? Tax rate. Wamesema ni ngapi, Abdi? 30%. So then what is 1 minus 30%? What is 1 minus 30%? What is 1 minus 30%? 70%, which is the same as what is 0.7. And this 0.7, ladies and gentlemen, does not touch this one. This 0.7 is only touching the debt to equity, like that. The debt to equity is what we are touching with this 0.7. So then, ladies and gentlemen, could you kindly tell me, this will be 1.368 equals BA into 1 plus, please give me this figure first. What is 0.7 divided by 5? Somebody give me this figure. How I wish I had my calculator here. How I wish I had my calculator. I can see already Abdi has gotten a figure. So it is 1/5 times 0.7. Somebody give me this in form of decimals. In form of decimals. So somebody is giving me a figure of 0.14. 0.14. Lucia has already given me that. Pamela has given me that. Thank you very much. So, ladies and gentlemen, what this would mean is that my 1.368 equals bar times basically 1.14, implying that bar will be 1.368 divided by 1.14. Can somebody give me this bar, beta assets? Can somebody give me this beta assets? I like what I'm seeing Agnes giving me there. I like what I'm seeing Liz one day giving me. Also Mwende. Very good. So beta assets, somebody is telling me it's 1.2. Now, ladies and gentlemen, if you look at even ACCA, you know, AFM borrows quite a lot from ACCA. You'll bear witness with me that in most cases, what the examiner of ACCA does, he'll tell you that this particular company wants to move into the plastics industry whose beta assets is 1.2. So if he tells you that beta assets is 1.2, ladies and gentlemen, then us, we are very happy because we will simply pick it the way it is and go to KU calculation straight away. So we go to KU calculation straight away, and our KU calculation, ladies and gentlemen, in this case here, our KU calculation will behave like this. Our KU calculation now will behave like this. Remember, this time round, we are not using Peter Motier's formula. I told you there are two formulas. One of them is the CAPM. This time around, we are using the CAPM's method of getting KU, which is risk-free plus ERM minus risk-free. And now that you've made mention to the word KU, KU means that we can't use B, we'll use B. Beta assets. So here there is nothing like, again, gearing, because what I'm interested in, how I wish I could even find a simple language of explaining this. Ladies and gentlemen, here I don't want your usual K. If I wanted CAPM cost of equity, then I would have used what we call the company's beta equity there. So again, I would have gone using Hamada's formula. I would go ahead with gearing this using the company specific debt to equity. But they don't want us to get cost of equity of the firm. They want us to give them the CAPM cost of equity, which is what here, somebody, which is unlevered, yes, which is unlevered, yes. So if that is the case, ladies and gentlemen, could you kindly try to look for those parameters for us? Is there anybody who is able to see the risk-free rate of return of this question? Risk-free rate of return. Is there anybody who is able to see the risk-free rate of return? Let's see. Risk-free rate of return. Yeah, they're telling me all of them. It should be what here? Somebody should be 10%. It should be 10%. So this is 10% plus. How about the market return? How about the market return of the portfolio? The market return of the portfolio, I'm being told it's 15% minus 10% multiplied by our bar, which will be 1.2, which will be 1.2. Ladies and gentlemen, that means that I should use what for my cash flows discounting. Here you have to be careful how you use your brackets. First of all, if I'm the one doing this, I'll say 15 minus 10 close times 1.2. And then I say plus 10. So Olivia tells me 16%. So in this case here, KU is 16%. So in this case here, use this to discount the project's cash flows. Use this to discount the project's cash flows. Use this to discount the project's cash flows. Now, ladies and gentlemen, I don't know whether I'm speaking alone. How many students have been able to follow up to where we are? Please, without, in this case here, sugarcoating anything. Without sugarcoating anything, how many of us have been able to follow? If you've been able to follow up to where we are, say yes. Mary has already put up her hand. So we have Olivia also, yes, yes. Aha. Me. Kuna mwenye amesema ukweli hapa. Makrina, I just saw you walking into the classroom. I just saw you walking into the classroom right now. Unfortunately, you came in too late. But nevertheless, thank you very much for telling us the truth. Yes. Okay. So knows ni chache, but of course, sijaelewa hata. Okay. Okay. Great. Now, I know what to do. Kiasi, I know what to do. Tuendelee sasa. Kutoka hapo utafuata. Hapa sasa itakuwa rahisi. And I'll make sure, in this case hapa, tutarudia. Yes. I'll make sure tutarudia. But of course, in a skillful way, because nikianza kurudia kutoka mwanzo, remember, I've already burnt 40 minutes. We've burnt 40 minutes. So now we've been able, ladies and gentlemen, to get cost of equity of an unlevered organization that we shall use to discount our project's cash flows, to be able to get what we call the base case NPV. So now we are looking for the base case NPV. So the base case NPV, the one that I've seen some student wants us to explain, ladies and gentlemen, first of all, we would want to get cash flows of the project. First of all, we would want to get cash flows of the project. Hii iko sawa. So kujeni hapa mtupatie base case. So base case NPV. Number one, give us the cash flows of the project. Cash flows of the project. I know I'll be discounting this of the project. I know I'll be discounting this at 16%. At 16%. So then what do we have here? The cash flows of the project. I like this. Wametuambia Blades, I'm reading the first paragraph. First paragraph, Blades Limited is considering, ladies and gentlemen, is considering diversifying its operation away from its main areas of business, food manufacturing, into the plastics business. The company wishes to evaluate an investment project which involves acquisition of a molding machine that costs shillings 450 million. The project is expected to produce net annual operating cash flows of 220,000 for each of the 3 years of its useful life. Its salvage value is 0. The asset of the project will support debt finance of 40% of its initial cost, including issue cost. The loan is to be repaid in 3 equal installments. The balance of the finance will be provided by placing of new equity. Issue cost will be 5% for the equity and 2% for the loan. Debt issue costs are allowable for tax. The plastics industry has an average equity beta of 1.36. Now tuachana na hiyo, wanakuja nasema last paragraph, the risk-free rate is 10% per annum and the expected return on average market portfolio is 15%. Corporation tax is 30%. The machine will attract a 70% initial capital allowance and the balance will be written off evenly over the remainder of the asset's life and will be allowable against what year? Tax. Ladies and gentlemen, here they have given us the rate of taxation. And because they want me to calculate for them the profit before, or rather the cash flows, then depreciation becomes relevant. So in this case here, we must come and calculate depreciation first. So could you kindly help Mwalimu here to calculate depreciation for this particular project? Please help Mwalimu here calculate depreciation. Why are you calculating depreciation? I am calculating depreciation because I know in finance, whenever the tax rate is given, then, ladies and gentlemen, I have to calculate depreciation because depreciation becomes relevant. So could you kindly help me to calculate this depreciation for this particular machine? This was a crazy examiner, a good examiner who really knows what students in this case here should, at least among us the 5 questions, in this case here, you must, if you're a good examiner, you must make the students, in this case here, heartbeat, at least to move quite fast in one of the 5 questions. Don't make the 5 questions have to be very simple. One of them should be like this. But of course, others should be what here? Easy. Especially question number 1. You make sure that question number 1 comes like that, if you're a good examiner. Because upon the students reading question number 1, which seemingly looks that hard and they don't have an idea, they don't have the know-how of how to tackle exams, most of them become so confused, they end up messing the entire paper. But somebody, of course, who knows that an exam is to be set like that, the first question can be hard. But of course, at the end of the day, if I'm courageous enough, all the other questions I should be able to tackle them, or even 1 and 2 at times could be tough, but 3, 4, 5 should be easy. 3, 4, 5 should be easy. 3, 4, 5 should be easy. So I'm waiting, ladies and gentlemen, for the projects. What here, somebody? For the projects depreciation. Year number 1, year number 2. Year number 1, year number 2. Alice, I don't know where you've gotten 105 from. So in this case here, they have given us capital allowances. So capital allowances, what have they told us? Year 1, we should claim virtually almost everything, which will be 70% of 450. Remember, the machine is 450. So you should claim everything, which Grace is giving us a figure of 315. Is there anybody who is able to see where Grace got that 315? I don't know where Alice got the 105, but that's part of learning. I like that. I like that. So we have here 315. And then we have year 2, year 3. Do you remember that this machine had a useful life over 3 years? Please, somebody help Dahir. Send Dahir this question. Send Dahir this question on WhatsApp. Dahir has just joined us. So remember this machine, ladies and gentlemen, this machine has an economic life over how many years? They must have forgotten that. Nobody's telling me how many years this machine has. Nobody's telling me. No, 3 years, isn't it? So 3 years. So meaning in this case, ladies and gentlemen, the total value lost, the total value to be lost over the 3 years should be 450 because the machine doesn't have any residual value. The machine doesn't have any, they have told us, the machine doesn't have any residual value. Meaning that over the 3 years as an accountant, I'm going to write off the machine completely. The value of the machine has to be written off over the 3 years, 100%. But now remember, they've told that you guys shall claim 70% in year 1. And then the remaining, what is the remaining value? Somebody. What is the remaining value? The remaining value is 135, isn't it? The remaining value is 135, and this is what is to be shared in the 2 years equally. So divide that by 2. So then each year we should claim how much here, somebody? 67.5. I'm really getting to like this because it's also helping me to understand my first topic, investment appraisal. Now, ladies and gentlemen, let us get clear with this. Let's be very clear with this. What if they told me that there was a scrap value of 10? What if they told me that there was a scrap value of 10? What if they told me that there was a scrap value of 10? Abdi is asking why divide by 2. We are dividing by 2 simply because they have told us in the question. If you read this question very well, there is a paragraph where they told us 70% initial capital allowance and the balance will be written off evenly over the remainder of the asset's life. And remember, the asset's life has got how many years? 3 years. Has got 3 years. Okay. Now, ladies and gentlemen, please don't do it the way I'm seeing you guys telling me. If they told me that the asset had a scrap value of 10, I would have said that the total value to be lost would have been 440. Because you see, 10 is not going to be lost. At least when we finish the project, I'll be able to sell that scrap. I'll be able to realize the 10. So the 10 will not be lost. So in this case here, the total depreciation or total value to be lost will be 440. So it will be 440 minus this, divided by what year? Divided by 2. But that is just obiter dicta. That is just what year? By the way, ours was 450. Ladies and gentlemen, from there now come back here. So we have our project's cash flows, year number 1, year number 2, year number 3. So they have given me operating profit. Operating profit, ladies and gentlemen, whenever any examiner talks of operating profit, what comes to our mind? Whenever they talk of operating profit, what comes to our mind? Because if you look at this question, ladies and gentlemen, they've told us the project is expected to produce net annual operating cash flows of 220 million. They're operational cash flows of 220 million for each of the 3 years of its useful life. Now, ladies and gentlemen, listen to me very well. Normally, when they talk of operating profit means it is profit before interest and what here, somebody? Tax. Operating profit is profit before interest and tax. But when they talk of operational cash flows, they mean, ladies and gentlemen, that most of these other expenses have gone through. Most of the expenses have gone through, except what here, somebody? Except the non-cash expenses. Except the non-cash expenses. Except the non-cash expenses. Now listen, whenever they talk of operational cash flows, just take it as somebody is telling us there, it is profit before depreciation. Of course, tax, if it's operational tax, has not been adjusted. It's profit before depreciation and tax, of which they have told us that once we buy this machine, ladies and gentlemen, will be helping us to save each year. They have told us that each year, we shall be saving how much here? Each year we shall be saving 220. So we have here 220 to its per annum, remember, to 20, like that. So then very fast, of course, there is the other shortcut method that I know most of you love it, but I don't use it myself. What I have is a longer way akize. Nakuja nasema hapa less, what they call depreciation, but of course we know in finance, depreciation and the capital allowances are the same. Depreciation and the capital allowances are the same. Depreciation and the capital allowances are the same. So then, ladies and gentlemen, what do we have here? So we have less depreciation. Depreciation already we have. For year number 1, we are recouping almost everything. Year number 1, we are getting how much here, somebody? 315. Year number 2, ladies and gentlemen, we shall be getting 67 point what here? 5. Here we shall be getting what we call 67.5, like that. So could you kindly come here and subtract for us? Kindly subtract for us to give us, ladies and gentlemen, profit before taxation. Profit before taxation, please subtract for us for you to be able to give us the profit before taxation. Please give us figures very fast. Please give us figures very fast. So the first one that I'm being given here is negative what here? 95. Negative 95. The second one? 152.5. And then we have 152 point what here? 152.5, like that. So please go ahead and give us the tax element. Go ahead and give us the tax element. So we are taxing this at what percentage? As the examiner given as the tax. As the examiner given as the tax. %, right? So we have here 30%. We have 30%, we have 30%, we have 30%, 30%, 30%. So could you kindly give us this? Remember, in finance, even if it's a loss, we tax. In finance, even if it's a loss, we tax. So we have here minus 28.5. How about 30% of this? 30% of 152.5. I have 45.75. 45.75. Of course, the other one will also be the same. 45.75. Thank you. Now, after that, ladies and gentlemen, come very fast here and give us profit after taxation. So profit after taxation, what are we supposed to do? We are supposed to take profit before tax. We subtract the tax element. So don't forget that here we shall be having two negatives. It will be minus 95, this minus 28.5. Minus 95 minus this. What figure are we getting, somebody here? Minus 66 point what here, somebody? Minus 66.5. Is that okay? 0.5 minus 66.5. And then we move very fast, ladies and gentlemen, to this one. Remember, you're subtracting. It's this minus this. Remember, you're subtracting. So I'm being given a figure of 106.75 and then 106.75. Thank you and thank you very much. Of course, having gotten profits after taxes and gentlemen, what do you think should be the next thing to be done? What do you think should be the next thing to be done? We add back depreciation, yes. We add back depreciation. We add back depreciation. Add back depreciation. So add back depreciation. So when you add back depreciation, what figures do we have? We have 315, we have 67.5, we have 67.5. So could you kindly give me these figures, ladies and gentlemen? Kindly give me those figures, ladies and gentlemen. What figures are we going to have here? So Mary gives me the first one as 248.5. The first one is 248.5. How about the second one? How about the second one? How about the second one? 174.25, 174.25, and then we have 174.25 like that. Thank you very much. So please, let's go ahead and discount these cash flows. While discounting this, because we only want the business risk of this, not the financing risk element of this, I would want to discount this. I would want to discount this. I would want to discount this. Year one, they're saying is wrong. Year one, they're saying is wrong. Minus 6.5 is wrong. They're saying year one is wrong. According to Faith, year one is supposed to be minus 123.5, and I know why. It's because Faith, Kawera, my sister, you forgot that this is taxation. This is taxation that is supposed to be deducted. It's supposed to be like a benefit to us. So as I press this in my calculator, I'll take minus 95 minus this minus here. And then the figure itself is negative. So I'll say minus 95 minus 28.5. So there are two minuses there, and I would really be very happy if I can get students saying, now we are okay. Thank you very much, MN. This MN gentleman should get a present. Should get a present. Should get a present. Should get a present. So what I was trying to explain, ladies and gentlemen, if it's APV that you've been able to get cash flows of the project, the next thing will be for you to go ahead and discount the values that we have here using what here, somebody, you discount the values that we have, discount the values that we have, discount the values that we have using KU, using KU. So discount, I hope you're writing that, discount the above values using KU, discount the above values using KU, discount the above values using KU. Discount the above values using KU. So using KU, then what do we have here? Somebody using KU. Here, I'm using this questionnaire to teach you so many things. Here, it's like I'm covering 3 topics with one question. Amada is here, financing is here, investment. The other shortcut, no. I'm not reminding you anything, Peter. Those shortcuts are not very good. They're not very good. I want what is good for you, Peter Mtiani, 20 longer way. Very good. So, ladies and gentlemen, so come here, we have time 1, 2, 3. We have our cash flows. Our cash flows. Our cash flows here, we have 248.5. Here we have 174.25. Here we have 174.25. So come and give us PVF. Do you still remember our KU was 16%? PVF, our KU is supposed to be 16%. Our KU is supposed to be 16%. If you can remember, our KU is supposed to be, our KU is supposed to be, our KU is supposed to be 16%. So then could you kindly give me these figures very fast? I know you know how to discount, right? I know you know how to discount. So how to discount? So we have here 0.8621 year one. How about year number two? Year number two, Badia, 0.7432. How about year number three? 0.64. 6407. 07. So please come and give us our present values. Come and give us our present values. Give us our present values. Two decimal places, present values, two decimal places. So 214.23, 214.23. Second one, I'm taking this times this. Please give me the second figure there. 129.5. 129.50. Then we have this by that, giving us 111.64. So 111.64. So please come and give us the total present value. The total present value. The total present value will be equal to 455.32. So from there, what do? We should come and less. The cash outflow, isn't it? We less the 450. So we less the initial outlay. Initial outlay of 450. So it's attractive. Now you should be able to get net present value, which is the best case. $5.32. Now allow Mwalimu to remind you something here. What if we had a scrap value of 10 in this question? Here on this table, how would have you addressed the issue of 10? If we had a scrap value at the end of the third year, you are told at the end of the third year, there's a scrap value of 10. How would have you handled that 10? I can see what Abdi is saying. You add the discounted. Yes. You can see all those students are really giving us something very nice. They're telling us, come and take the scrap value, multiply by the PV for year 3. Another student there, I think it's Lokai, who has told me, Mwalimu, if I had this scrap value of 10, I would have come and added it here, plus 10. And then, of course, get the total times this. Correct. Thank you very much. Now, what if, ladies and gentlemen, in the same question, what if we had working capital of 20? What if we had working capital of 20? Where you have to inject working capital, Kusema ukweli, hao wanafunzi si wameiva AFM, si wameiva. Kitu nasema ni mwalimu, hata mimi sita hustle sana. Najua working capital lazima itaficha kwa initial outlay. So ile initial outlay ya 450, kama kuna scrap ya working capital ya 20 ya kuja kusaidia hii project, nita add hapa. Kwa hivyo in short, my initial outlay itakuwa 470, 450 for buying the machine and 20 for ensuring that things are working. But now what these students have done to make me very happy, they have known one thing, that these 20 will have to be released at the end of the project. Project inapoisha namna hii, unachukua ile scrap value na working capital unaziweka pamoja. Au wanafunzi wamesema chukua 20 una add kwa initial outlay na pia una add hapa kwa scrap. Una add kwa scrap. Lakini sasa hiyo ni swali lingine. That's something for another day. So ladies and gentlemen, here we are. Kujeni hapa, toa hiyo namna hiyo. So tumeambiwa NPV hapa ni 532. Ni 532. Now, ladies and gentlemen, having gotten that, now remember, when we began, for those of you who came in quite early, we said that this APV is quite similar to Modigliani and Miller 2. Value of a levered farm equals value of unlevered plus debt times tax. So the unlevered farm, the value I've gotten here is like value of the unlevered farm. Now you need to go to the other side of the coin and ask yourselves, how about financing? How are we financing this money? How about financing? So mention there, present value of financing effects. 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 So tuanze na debt. So debt, I am after the interest amount. And for the purpose of this, ladies and gentlemen, I would want us to simplify, because I can assure you APV is not more than 100 students who can get any question here APV in an exam in Kenya. Not more than 100. So tukianza kuenda ile concept ya nini? Ile concept ya kusema at reducing balance. Right? Itakuwa noma. So the best hapa ni kucalculate interest, useme tu interest per annum. Uassume interest itakuwa the same. After all, wanafunzi wangapi watafika question hapo? Wangapi? Wewe sema kwamba interest zote, even if the examiner mentions installment, of course that should be the way. But here for simplification purposes, always assume that interest will be equal throughout the loan repayment period, which is not the case. Of course, all of us know that this thing is on a reducing balance basis. It's on a reducing balance basis. But for our simplification purposes, and this should not scare you, because of course I'll be in that panel, marking panel, I'll tell people straight line, and they have to listen to Mzee, straight line. So, ladies and gentlemen, here we are. So interest, we are going to assume that interest is what here is a straight line. So could you kindly give me the interest, then, ladies and gentlemen, if it's straight line, or could you kindly give me the interest per annum, if it's straight line? Interest per annum, and the assumption here is that we are using straight line. So if it is straight line, then we need to know the amount of debt. You'll be able to understand this, Marion, as we get on. The amount of debt borrowed. So could you kindly give me the total debt first of all? I know the rate of interest. Please give me the total debt. The total debt. What have they said about total debt? Total debt. In paragraph number 2, they've told us the asset of the project will support debt finance of 40% of its initial cost, including what here? Issue cost. The loan is to be repaid in 3 equal installments. So, ladies and gentlemen, the debt here is 40%. So this amount of 450 is split into 2. We are going to raise it using a debt instrument, and debt they've told us is 40%. So 40% of 450, I know. Those students who are saying 183 point, I know. So 40% of 450, Grace tells me that this should be 180. I know it's million, but we are forgetting the millions. And then, of course, equity, this has to be equity. Equity will be 60%. So can someone talk to me? 60% of 450 gives me what here, somebody? 270. But ladies and gentlemen, this is a broke company. This is a broke company that wants even to borrow issue costs. They can't even afford issue costs. We've been told in this case here, the loan they'll be borrowing, ladies and gentlemen, must include the issue cost. This is a broke company. It's a broke company that wants the issue costs to be put in as part of debt. So we are being told there, if you go to paragraph number 2, the assets of the project will support debt finance of 40% of its initial cost, including issue costs. So issue costs have to be included. The loan is to be repaid in 3 equal installments. The balance of the finance will be provided by placement of new equity. Issue cost will be 5% for equity and 2% for the loan. Debt issue costs are allowed for taxation. The plastic industry, so the most important thing, ladies and gentlemen, is that when we go to borrowing, we must ensure that, especially debt, we must ensure that we will borrow a little bit more. So that some amount will go to cover the issue expenses, and then exactly 180 will go into our project. So naandika hapo, therefore, the total amount to be borrowed. 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 Total amount to be borrowed. Total amount to be borrowed will be 180 divided by 0.98. Quite technical. You'll always get students confusing this and saying that the total amount to be borrowed will be 180 times 1.02. 180 times 1.02. No. This 180 is the net, which is going to the project. And therefore, the percentage you're using here should be net percentage. Net percentage, so net. So can somebody first of all give me this? So Ruth is saying it should be 183.67 like that. 183.67. If you try saying 102 of 180, you'll not get exactly that. No. What we are saying is that this amount of 180 is net. It is at 98%. What about 100%? It should be equal to what? The way I like arguing this is 180 divided by 0.98. 0.98 tumetoa wapi? Asante sana. Mali tumetoa ni hapo wamesema issue cost will be 5% for equity and 2% for the loan. So 2% is going for the loan. So 2% out of 100%, then that leaves us with 98% to invest. And this 98% must be exactly equal to 180. 98% must exactly be equal to 180. 98% should be equal to 180. 98% should be exactly equal to 180. How about 100%? Now, let me surprise you. Out of this, you see, this is the total amount to be borrowed, right? And we know that, ladies and gentlemen, to finance the project. So in this case here, debt for financing the project. Financing the project is 180. Is 180. So when you take 183.67 minus 180, then you should be able to get to what we call, the issue cost of debt. The issue cost of debt. The issue cost of debt is 3.67. The issue cost of debt is 3.67. Please do me a favor. Could you kindly give me 2% of 180? What is 2% of 180? Somebody may say that issue cost is 2% of 180. If you say 2% of 180, no. If you say 2% of 180, you'll get exactly 3.6. But if you say 2% of this amount, just try and see 2% of this, say for rounding off errors, 2% of 183.67 should be able to give us this 3.66 or 3.67. Just try that, you will see. You're magic. Unaona? The magic. And of course, if I'm teaching you, ladies and gentlemen, if I'm teaching you AMA, of course, for example, when you're told that when you procure these raw materials, 10% will go into waste. So for you to know the exact material quantity to procure, you normally take, like, for example, 100 divided by 90%, because the 10% will disappear. The 10% has to be subtracted. The same case, these issue costs are not coming to help us. It's wastage. If you are to be very efficient, even issue costs should never be incurred. Very efficient organizations in this case, ladies and gentlemen, that are really known by the public outside here, their issue costs are very small. So whatever they raise basically goes to what here? Somebody goes to investments. But those organizations which are not very much known, which, for example, are not exercising proper corporate governance, they need to do more to cheat the public, to give them money. So what are we saying, ladies and gentlemen? Whenever they say, ladies and gentlemen, that we have got what here? We have got 2%. Like now here, I like what I've seen Mutia saying. Mutia says that, Mwalimu, this issue cost, we can calculate this issue cost this way. I like this. Mutia says that, Mwalimu, we know that issue costs are 2%. But now 2% of what? It cannot be, it is 2% out of the total amount, right? Which is net now. So if you take 2% out of 98 and then you multiply this with this amount that you guys are given me, was it 180? Could you kindly try doing this? So of course, percentage will cancel out. What is 2 over 98 times 180? Yeah. These are very good approach, but very few students will be able to remember these. What I know many students of mine are able to remember. When you're told that 180 is net, the net amount needed is 180, then down here we have to divide with the net percentage, which is 98%, which now will end up giving us 183.67, and then we come under less, in this case here, the amount that we need for the project, giving us 3.67, like that. So this is the issue costs. Now, two things, ladies and gentlemen, two things. Now, ladies and gentlemen, two things. Number one, interest per annum. Could you kindly give me the interest per annum? Remember, we have said, for simplicity, don't do it the way I was showing you in our last class. That is the proper approach, but please avoid that. Right now, where we have reached, we must know how to tackle these things easily and in a way that we'll be able to get all the marks. So is there somebody who is able to see the rate of interest? As this examiner given us the rate of interest. They're not talking to me. They are not talking to me. The rate of interest. Rate of interest, whenever your examiner is silent about rate of interest, it shall always be equal to what here, somebody, to the risk-free rate of return. Whenever your examiner is silent about, ladies and gentlemen, the rate of interest, it shall be equal to the risk-free rate of return. Remember, debt amounts, unless it's a useless bank, debt amounts are normally done what? Debt amounts are normally collateralized. They normally go with collateral, and therefore they are what? Risk-free. Kama, for example, ukienda borrow from a sacco, watakwambia bring collateral. Either you take your car there or you take a guarantor. So if you run away from paying your obligation, the guarantor's money disappears or your vehicle disappears. Is there anybody in this classroom whose shares have ever been chopped because of guarantorship? Anybody whose shares have ever been chopped because of guarantorship? Because of guarantorship? It's quite a bad feeling. Yes. Wasibu, yes. Oh, you are the chopper. Wow. So, ladies and gentlemen, risk-free, debt is risk-free. Debt is risk-free. So please come and give me the interest per annum. So interest per annum, somebody tells me it's 183.67 times 10%. So this is risk-free. This is risk-free. It's risk-free. So if it's risk-free, could you kindly give me that? Remember, even the issue costs, it's debt you took. It's debt you took. It's debt you took. So per annum, mm-hmm. 18.37. So this becomes 18.37 per annum. So what is the tax savings on interest? What is the tax savings on interest? Tax saving on interest, ladies and gentlemen, will be 18.37 times 30%. Remember, the entire interest will be what here? Somebody will be tax allowable. Will be tax allowable, right? So I pass it through tax, right? So if it's tax allowable, then, ladies and gentlemen, I'll be saving 30%. It's like an income. It's like I'm earning. So what is 30% of this? So I'm being told this is 5.51. So then what is the present value? Present value on the tax savings of tax savings on interest. Present value of tax savings on interest. So it will be 5.51 multiplied by PV for 3 years, but the percentage, I've forgotten the percentage. Times PV for 3 years times the percentage. I forgot the percentage long time ago. I forgot the percentage, and I like what I'm seeing. I'm seeing quite a lot of democracy today. Students are giving me, in this case here, varied answers, and now it will be very hard. It will be very hard for us really to come to a conclusion on who is right and who is wrong. Who is right and who is wrong. Ladies and gentlemen, since I was born and I did this finance, I've never seen a situation where interest is being discounted at KU. You'd rather you talk of any other. KU is cost of equity of how do you bring issues of KU in where interest in this case here are, right? Hiyo ni kama lile na fila havitangamani. Hiyo ni kama uleta Muislamu hapa Abdi na uweke nguruwe karibu, hawezi pelekana. Hiyo ni international disaster, right? Haiwezekani. So, ladies and gentlemen, remember that anything to do with interest, if you're told to discount, you always discount at KD. Always discount at KD. So it should be 10% risk-free. Sijui tunaelewana. So please, interest na KEU kwanza. Interest na KEU aki hazipelekani. Hiyo ni kama mafuta na maji. Mafuta na maji hazipelekani. So tunaelewana kwamba hii utadiscount na 10%. Are we together? 10%, not 16%. Thank you very much. Remember, here we are looking at present value of financing effects. So everything here will be discounted using the cost of debt, which you guys told me is 10%. But I'm not seeing many yeses, honestly. I've only seen 2 yeses. Yes. Thank you very much. Now, what I also do not know is whether, is there anybody who does not know how to read this PVFA? Is there anybody who does not know how to read the PVFA? Is there anybody who does not know how to read the PVFA? Please read for me. PVFA, 3 years, 10%. Remember, the loan has to cover the entire what? Has to cover the entire, has to cover the entire project life, which is 3 years. So then this will be 5.51 times 2.4869. Please give me this figure. So 13.7. This is a very important figure that has to be double underlined. Very important figure that has to be double underlined. Very important. Very important. Have you done that? Very important. Thank you very much. Now, after that, ladies and gentlemen, in most cases, the examiner will tell you that issue costs are not allowed for taxation purposes. But this was a crazy examiner. He told you that issue cost is tax allowable. That is what he told you. Tax allowable. So please give us issue cost on debt, remember. Issue cost on debt, remember, he told you that this is what here, tax allowable. And then we know that the issue cost is 3.67 times 30%. Therefore, the savings, tax savings on debt issue cost. Akiana kuchezea debt issue cost inakuja ngapi somebody? 1.1. Thank you very much. Double underline that figure. Aya. Sasa tuende kwa issue cost ya equity. Issue cost of equity. Issue cost of equity. And I would want us to borrow Motier's method. 9 over 95. 9 over 95 times 270. Let's borrow Motier's, Peter Motier's method. Peter Motier's method. $14.21, $14.21, $14.21, $14.21, $14.21. Remember the other method, my method, which would have been a bit longer, I would have taken, first of all, are we able to see where 270 is coming from? Are we able to see where the 270 is coming from? Yeah. So my method, I would have taken 270 divided by what if you're following? My method, I would have taken 270 divided by what? My method. Divided by 95%, isn't it? Yeah, divided by 0.95. And then, of course, after minus 270. That's what I would have done. To get the issue cost, this is what I would have done. But if I look at Motier's method, if students will be able to remember, even if you can't really remember why we are doing this, you know, now we have even reached that stage where we encourage students to cram. I think Motier's method is good. You're able to get that issue cost directly. Now, issue costs on equity is never tax allowable. Issue cost on equity can never be allowed for what year? For tax. By the way, I'm not guessing this thing. It's the examiner who has said that. I'm not guessing. If you look at paragraph number 2, what have they told us? Line number 2. Issue cost will be 5% for equity and 2% for the loan. Debt issue costs are allowable for tax. Remember, the government knows that debt is a good source of finance. So the government would always want to give you motivations. Would always want to motivate you to use debt. And that's why they tell you that interest is tax allowable. Dividends are never allowed. Dividends for equity are never allowed for tax. If it is issue cost on debt, they'll be allowed. But if you raise money from your own shareholders, there is no way you'll expect the government to give you a tax waiver. No. That can never happen. Because if they allow that to happen, then every time I would be taking my money to RCM as a shareholder. And if I put my money at RCM, then I know 30% of that money will be saved. No. That will be opening some Pandora's box for what year? Tax evasion. So for issue cost of equity, ladies and gentlemen, then we don't do what year? We do not allow for taxation. We don't allow for taxation. So, ladies and gentlemen, that is it. Now come and give us our famous APV. Give us our famous APV. So our famous APV will be equal to the base case, NPV, base case NPV plus the present value of present value of tax on interest, which you got, right? Plus present value of debt issue costs. Present value of debt issue cost, right? Present value of debt, Goja, plus present value of debt, of tax on debt issue costs. And then number 2, minus issue cost of debt, minus issue cost of equity. Quite scary. Remember also, issue cost of equity falls under this, under what we call financing. It's a source of finance. So could you then, ladies and gentlemen, kindly give me these figures? I know you have them. Someone is in the waiting room. We shall overcome. Tafuta polepole, usikuwe na wasiwasi. Mara mwisho utaelewa sana hii kitu hii. Mimi simuoni. So Alice, tuende polepole hapa. Base case, Grace anasema ni 5. Base case 5.37. Base case 5.37. Base case 5.37 plus, what about the present value of tax on interest? Present value of tax on interest inakuja ngapi somebody? 5.32, okay. How about the present value of tax on interest? $13.7. So plus 13.7 minus, what is the tax on debt? You know the issue cost is being incurred today. So issue cost, we don't discount them because they're being incurred today. We are only calling them present, even these ones. We are not going to discount them. Issue costs are never discounted. So is there somebody who is able to see the one you guys were asking about? Was it 1.1? Present value of tax on debt issue, 1.1. How about the issue cost of debt? The one that Motia did like this, 2/98. Was it 3.67? 3.67. And then we have issue cost of equity itself. Issue cost of equity itself. Issue cost of equity, mnasema ni 14.1 ya 14.21. Thank you very much. Now, so hebu subtract yote, uniambie inakuja ngapi somebody? Subtract yote, uniambie inakuja ngapi? Uniambie inakuja ngapi? Subtract yote, uniambie inakuja ngapi? Wanasema ni 2.24. And therefore, the project is viable. The project is viable. The project is viable. Now, I know, ladies and gentlemen, of course, this has been a very tough session, very tough indeed. But I would want you to do me a favor. I even don't want you to master this question in a way that you'll be able to get all the marks. No. I simply want you to reach a scenario, to reach a level where at least you're able to touch on something here, something there, for you to be able to get, for example, 7 out of 13 or 7 out of 12. And there are those really low-hanging balls, low-hanging balls, low-hanging balls. My NPV as 55.32, 55.32. So these are questions on Zenka. I'd forgotten to record Zenka, right? We are told the managers of Zenka are investigating a potential $25 million investment. The investment would be a diversification away from existing mainstream activities into the printing industry. $6 million of the investment would be financed by external funds, $10 million by rights issue, and $9 million from loans. The investment is expected to generate pre-tax net cash inflows of approximately $5 million per year for a period of 10 years. The residual value at the end of year 10 is forecast to be $5 million after tax, as the investment is an area that the government wishes to develop. A subsidized loan of $4 million out of the total $9 million is available. This will cost 200 points, 200 bases. It's called 200 basis points. 200 basis points below the company's normal cost of long-term debt, which is 8%. 8%. So, ladies and gentlemen, listen. Whenever you hear of 1%, 1% is the same as 100 basis points. Let me repeat this. This is an area that this examiner, one of the fine days, should surprise students by talking of basis instead of percentage. So one thing you're supposed to know is that 1% is always equal to 100 basis points. So meaning basically that 200 basis points are the same as 2%. So when they say that the government's loan is subsidized by 2%, it means that the normal loan is 8%. And then the government loan, which is less by 200 basis points, less by 2%, then that will be what here, somebody? 6%. Very important for us to know that. So ukisikia 200 basis hiyo ni sawa na 2%. 2% less. This will cost 200 basis points below the company's normal cost of long-term debt finance, which is 8%. Zenka's equity beta is 0.85, and its financial gearing is 60% equity, 40% debt by market value. I'm not interested in Zenka's equity. I'm not interested in that at all. The average equity beta in the printing industry, the new industry that would want to get into, the average equity beta in the printing industry is 1.2, and the average gearing is 50% equity, 50% debt by market value. The risk-free rate is 5.5% per annum with an equity risk premium of 6.5% per annum. Issue costs are estimated to be 1% for debt financing, excluding subsidized loan, and 4% for equity financing. It can be assumed that the debt capacity available to the company is equal to the actual amount of debt financed raised for the investment. These costs are not tax allowable. So as assisted, as has told us even the issue cost on debt, not tax allowable. The corporation tax rate is 30% and is assumed that the tax payment and the refunds are made in the same year without delay. So they want us to estimate the APV. APV, ladies and gentlemen, that question you may not be able to get everything, but I mean, there are low-hanging fruits. So if you got that kind of a question in an exam, where would have you begun from? What would have you done, really? Please don't tell me that you'll be able to get everything. Even this one has got a subsidy. This one is exactly the same as the one that you had sent to me, the one of September 20. Was it September 2015? I think there was one on September 2015, which had a loan subsidy. Was it September 2015, the question that you guys sent to me? There's a question that was sent to me last time. Had a loan subsidy. Thank you very much for confirming that. But now, given this question here, what do you think? What do you think should have been the easiest part to knock this question from? Very good. Very good. Very good. Abdi has understood. Abdi will be able to get 3 marks even without knowing what he's doing. Abdi amesema ataanza na ungearing. Hamada's model. What Moses has also told us. Getting beta asset. All those are correct things. Can I give you 5 minutes, ladies and gentlemen? Please, you try to give me that answer. 5 minutes only. 5 minutes only. Please don't run away. I can see 2 students have already ran away. They were 57. Now they're 55. Don't run away. Let's try to really